Hello everyone, this is Jose. We are about to get started in around 1 minute, a little less than a minute. Let's have a quick sound check, if that's okay. Quick message on the chat box. Joanne, I see already you said morning. How are you, Joanne? Quick message on the chat box, that would be great. So I know you hear me. It's nice to say hi, and that means you heard me. So that way we kill two birds with one stone. So let's do that. 30 seconds to go, and we begin our option session, everybody. Thank you so much. Nice, everyone. Thank you. Ten seconds to go. Five seconds to go, and it's time to begin. Mark, my friend, very good, wonderful, everybody. Welcome to the session. We are now live. This is Aug-18, 2022. My name is Jose Blasco, and we are here to trade options. So this is our options trading session live. We're going to be looking at options markets. I'll discuss in a moment the agenda. Before we get started, financial disclaimer. Please read it carefully. It's in the upper left side of the screen. As you can see, it's being highlighted. It is fairly short, it is important, and therefore I'm counting on you all to read it completely. Thank you very much. The agenda for today, as always, the structure is always very similar, really. We look at the markets, we understand the environment. Options on equities are fantastic to trade, but at the same time, those equities are very dependent on sectors, on the S&P, etc. And understanding the market environment is key to do a better job at trading and building a portfolio. From there, we'll move into reviewing the trades that we have running, doing some managements if needed, which there are today. And from there, we'll move into looking for new opportunities, and hopefully we'll have time to do a few. Every day, of course, is different. Some days are easier than others. Anyway, so let's get started with the session now that it's all official, it's all introduced, and we are ready to go. And everyone, please, during the session, do not be shy. I know you are not. But I just want to highlight that this is a coaching session and you're supposed to ask questions, and I'll give you answers. And if you don't have questions and I have questions, then you are supposed to give me answers. And that way we can work as a team, and this session can be more efficient and productive for everybody. Talking about questions, we have something called the questions page. You can find the questions page using tradewithufos.com/Jose. We call it the questions page because as you scroll down to the bottom part of the screen, here we go. Here are the questions, and there are many. There are multiple pages with questions, so you can search. If you are looking for some answer, you can search for that, and maybe the answer is there waiting for you because someone in our community already asked that question. And if that's not the case and you don't find your answers, then you can just post the question clicking on the green button. Be generous, please. Upload charts, upload graphics that help us to fully understand your question properly. So be detailed, and that way you will receive answers from our support team, as well as any other member of the community could participate and also comment on others' questions and answers. Okay, cool. So with all that said, I am now focusing on top. So what we have on the screen right now is top, our predictive options planner. The symbol that is currently loaded is the SPY ETF, S&P 500 Index ETF. Before we look at that in detail, I would like to start the session looking at the VIX, which basically is going to be a copy-paste comment compared to what we had last week. The VIX is basically trading at 19 something, kind of 20. Last week, it was more or less there. So in other words, we are talking about a low volatility environment, even though, of course, it depends on the time horizon. If you look at a few years back, a low VIX was more in the area of 10, 12, and 20 is kind of double than that. So it's not like volatility is so low, but at the same time, if you look at what was happening not too long ago, we were hitting levels of 30 VIX, 30 plus, almost 35. And therefore, 20 is certainly not a high value. So this is something to keep in mind, because in a moment also I'm going to be looking at the technical analysis of the SPY, and therefore talk more about directional or versus non-directional, etc., and understanding what the average volatility of across stocks, at least the ones that make up for the S&P 500 index. It's important because When the VIX is low, it will tend to go back higher. When the VIX is high, it will tend to go back lower. And therefore, understanding where we're at, it's indeed relevant. Okay, so right now we are in a low volatility environment. Could we find opportunities where certain stocks have high IV? Yes. But again, you would expect the majority of the stocks to be more on the low side than the high side. And most importantly, you would expect volatility to rise versus volatility to drop, because the VIX being low would often imply a rise in volatility. Okay, because obviously when it's low, then there is more room to move in the upside than to the downside, because it's low. I guess it's common sense. Anyway, so now moving to SPY, which is the S&P 500 index. Very interesting market behavior, the one we have in front of us. So in one hand, if I zoom in here, we're looking at the auto climate and the statistics. Okay, extremely interesting market behavior. So 16 out of 6. I mean, this is over, it's kind of like a 3 standard deviation of duration. This is extremely unlikely. Not only unlikely, but very, very, very unlikely, especially with a market index, okay? Because stocks, again, sometimes with stocks, we see exaggerated climates. And again, because stocks are depending on factors other than the stock itself, such as the sector, the groups, the industries, competing companies, etc. So sometimes some stocks just go crazy, statistically speaking, and you see very high climate numbers. But with the S&P, 16 out of 6, not sure why I was speaking Spanish there. 16 out of 6, it's really intense, and it's certainly something not to be expected, but it's happening. The count that we have this week, when it comes, sorry, not the count, the max distance value that we have this week, I believe it's the same as the last week. We got up to 1.73 that was achieved on the prior week. So that has not changed. But again, 173 is way more than 0.78. So just like the last week, exactly, you are right, Joan. Just like the last week, we are in a market condition that is statistically unsustainable, but it keeps going, right? It keeps going. Now, the one thing that we saw last week is that for a moment, the gray line went slightly above the blue line. For the ones of you watching this recorded or new to the sessions, the gray line is the implied volatility of the puts, where the blue line is the implied volatility of the calls. So having the puts above the calls, right, that's a very, very bearish thing to happen, because that means that there are sellers in the market. Now, the difference between those two lines was very minor, but it's black or white, it's above or below, right? So it was above, so we had presence of sellers in the market, right? But it seems that those sellers were located way higher in price, because then the market gave another push, and that was really not expected. Not expected because, first of all, from a statistical point of view, we were already reaching levels that were way beyond 6. But on top of that, now we had sign of sellers in the market, and therefore that additional push was absolutely not expected. I was absolutely not expecting that to happen, and it did happen. Now, what's even more interesting than that is that that push is now followed by the blue line going back above the gray line. Okay, and what that means is that buyers are showing up again. So I guess that, again, you never know what's going to be, of course, the news and, financial networks, such as TV channels and so on, they will make up, hypotheses, if you wish, to explain why things happen the way they happen. The reality is that you never know why things happen. You just know they happen. So again, if we were to, speculate a bit on why it happened, or maybe, the interpretation of those inflation rates that we saw recently, not only in the US, but in other countries as well, getting much better, etc., etc. So all of those things maybe is creating a lot of calm in the marketplace, and that's why buyers are showing up. We don't know why, but the fact is that last week, the gray line was above the blue. This week, the blue line is above the gray. So buyers are coming in the markets. That is great, but it's not happening at the right time, because, again, statistically, we cannot forget that 16 out of 6, it's a very exaggerated market condition, which is extremely unlikely going to sustain. So what to expect, what to do? Again, given the fact that the implied volatility is low, given the fact that the climate is in a position where betting to the long side, it's way too late. Betting to the short side, if you were an aggressive trader, could make sense, but with the blue line above the gray line, probably you would only get very tiny profits if you were to counter trend trade. So because of that, non-directional trading will be my choice, just like last week. Okay, so we will be exploiting that type of opportunities and see if we find good setups this week. And that's going to be the safe approach, at least based on my trading rules and so on. That's going to be the safe approach. Now, what to expect? Because again, we won't meet until next week. So something that we certainly expect is a change of climate. Again, I already expected that last week. So even if we got the blue line above the gray, the fact is that the climate is exhausted, statistically speaking. So we should see a change of climate. And again, a change of climate may be like what statistics suggest, which is 3 candles down, like it happened here. Maybe 1 candle down, like it happened here, or here, even at 1 candle down, and it was unconfirmed. So we don't know what's going to happen, but the moment the climate turns red and back to blue, with this condition, with the blue line above the gray, I would say we are set in a market condition which is definitely very powerful to become a buyer and find buying opportunities to the long side and add directional opportunities to your portfolio, assuming all of this is happening and those opportunities meet your trading plan rules, right? But that's the market condition, that's the environment that we have in front of us. And I could totally understand, again, some of you in the group are more experienced than others. And again, some of you watching this recorded, maybe this is your first year trading, or maybe you've traded for 20 years, I don't know. But the reality is that this condition, especially if you're new, is a difficult condition to digest, because you just see the market keep going, and not only there is fear of missing out, actually you missed out already on a lot of a move, and therefore the level of lack of patience or the level of greed that may kick in is intense, and that's the recipe to get hurt bad. So again, more than ever, I should not say more than ever, because as traders we should be emotionless, right? But if I could, I would say more than ever, we gotta be patient, and we just need to act on the market data we got in front of us, and be disciplined and understand the market is the boss, and sometimes the boss will behave, sometimes the boss will not behave, and that's what it is. But we cannot fight it, okay, or be too daring with the boss, because it's the boss, right? So anyway, so patience, okay, and self-control and all of that. And if you have any comment, or you've noticed that in recent times you're lacking patience, you have some temptations, so it's always healthy to talk about it. So feel free to type on the chat box, and we can talk about it all together. Okay, this is very important. I never separate in the coaching sessions that we do. I never separate trading from trading psychology. I never trade like today I'm gonna coach you, and I'm not gonna talk about trading psychology, right? So that never happens, because in the end it's very relevant, and clicking the button means that we are the ones doing it, and we are human. So many people have amazing trading skills, and they really mess up, sorry for the word, just because of the trading psychology. So all those comments that I make, which may be obvious to you if you're experienced, may not be so obvious to new traders, and they are key for success and consistency. So keep all of that in mind. Okay, so see a few more comments there from Joanne. Yes, thank you so much, Joanne. This matter of fact tool, I love the way you phrase it. Yes, I see the matter thing. Anyway, so that's the market environment. So now let's review positions that we have. Okay, so the first one we're gonna review is MU. Okay, Micron. This one we're gonna review very quickly, because we should be out of this trade. We got multiple opportunities to be out of this trade, but I'm not out. Okay, so if I show you the account, I still have the trade here, MU, with a $16 positive per contract. Well, what's the reality with MU? Well, with MU, if I zoom in here, so we got in on that particular day, and that market went all the way to the speed bump. Okay, kind of kissed or almost kissed our target line, which was this line here in the middle, and then collapsed aggressively, and then came back up and definitely surpassed the target line, and now it's down, and now it's going back up again. So if you missed exiting that day, definitely you should not have missed it a few days ago, as we were reaching the target, and this trade would be over for whatever profit that was calculated or achieved. If any of you guys were in this trade, close the trade, and you feel like sharing the specific profit per contract you got on this trade, that'd be great. Do it on the chat box. If you want to keep it to yourself, of course, I always understand, but I'm just saying that it's time to be out of this trade. Okay, I'm not, because obviously we meet once a week, and I like to do the executions with you guys, so you see it done. Obviously, this often gets me into exiting at the wrong time. So today I'm going to exit for much less profit than what this trade would have paid. But in any case, so this is what this trade has done. Now, what's the lesson to learn here? Well, the lesson to learn is that we picked that stock, being a stock that belongs to a group that was strong. So that stock belongs to semiconductors. If I'm not mistaken, that was a sector that rotated on that day, as you can see. So we went from negative to positive. So there was a sector rotation in the semiconductor industry, and this motivated us to get on board, and that's one of the reasons why this trade worked pretty okay. Now, while all of this is the case, you also want to acknowledge the power of those speed bumps, okay? Because while the stock belongs to a strong industry that is rotating, and while the S&P has been fairly pushing up fairly, still that stock experienced a very severe drop at this moment in time, as well as here. So what's the lesson to be learned here? Well, the lesson to be learned is that when we set targets based on the speed bump tool, remember, when we define that speed bump tool, one of the ways on how I define it when I talked about it in the past many times is, the speed bumps is a tool that is often looking for significant turning points. Sometimes that obviously that tool, like any other trading technique, sometimes it fails. But at the same time, what you don't want to do as a profit taker, as a trader that is looking to take profits on a trade that is profitable, you don't want to look at the speed bump like hoping, okay, this time is going to fail, because the reality is that it works pretty okay, isn't it? So, and this is a great example of two cases, okay? And again, talking about trading psychology, building confidence on your rule set, building confidence on what is it that you do when you trade and why you do it. So again, I think this is a great example, and I wanted to point at it, okay, in the sense that we have a set of rules, we do things because of a reason, and when that it's kind of like so visual as what we have in front of us today. So I guess it helps to build the good habits into future trades, okay? Because again, when you guys are trading, and let's say you trade from home, or maybe you have an office and you trade from the office, and you are there by yourself, right? So temptations may kick in, and you may be like, oh, you know what, I'm gonna let it run a bit more and see what happens. And again, we gotta be mechanical as traders, because we are looking for consistent outcomes out of our trading activities, okay? So being a mechanical and not being doubtful of whatever decisions you had at the beginning of the trade, and just trade the plan that you planned before. It's extremely important, okay? Joe, thank you so much, my friend. I'm going to review the other trade, and then I will look at the USO options volume that you were mentioning. Thank you for reminding me about that. Thank you for that. I did send you that email for you to remind me, and I really appreciate that. You also mentioned a specific strike, if I'm not mistaken, and a specific expiration date. So if you don't mind to type that on the chat box as well, so then I don't need to go check the email that you sent, Joe, and we can take a look at that and comment, okay? Now, so Micron, again, it's a trade that, we should be out. So, talking about good habits, if I missed it, I missed it, but it's time to be out. So I'm just going to get out, create a closing order. So I'm going to click buy one vertical. And now you can see here the midpoint is 92 cents. So again, as always, I'm just going to try to get filled at that price, and later in the session, if I haven't been filled, okay, I just got filled, so that's it, I'm out of the trade. So we generated a little bit of a profit there on that one, okay? So thank you very much, Mr. Market, and now let's continue. September 16, very good. And what strike? I remember you mentioned there was one strike that had extreme volume, or no problem for me to look at the whole set of strikes, but if you had some specific interest, I'd love to know. And then finally, Nucor. So we are in this trade, and there is management to be done here in this trade, same as what we did last week. So the current price of Nucor is 142.59. Okay, so we are within our purple lines. If you recall this trade, so positions, right click on Nucor. So this is a double calendar. Okay, this is a double calendar. And this double calendar is now showing a little bit of pain because the stock went higher, which is the green zone. Now it went a bit lower. Therefore we are down a little bit in the red zone. Again, this is a trade that is going to last until October 21. So we are in the process of what I often call massaging the trade, right? And today we have work to do to continue working on that trade, which is made of using the 150 strike and combined with 125. Okay, so we are currently short the August 19 expiration dates units, which expire tomorrow, obviously, and therefore the analysis we should be doing, which today we'll see how it shows, because today the options are not so close to being at the money or in the money. So let's take a look. But the exercise we should be doing with Nucor is to compare the Greeks of August 19 and August 26, which is the next expiration date. Those are the only two expiration dates we care about. We would like to look at one strike only above and below, and the one strike we care about is again 125 on the bottom part and 150 on the upper part. Now the question we have is, are those Greeks distorted? Okay, that's the question. So we'll start with the calls, which are the 150 strike. Okay, so if you look at the 150 strike using August 19 expiration, okay, so we can see how the bid and the ask ranges between 3 cents to 11 cents. Okay, so the midpoint is somewhere there, and the theta value is 18. So in other words, we are supposed to make $18 per day, and we still got 1.5 days to go until the expiration. So technically or theoretically, theta tells us that we may make 30 cents on time decay. But the reality is that the only value left here is between 3 to 11, which is way less than 30 cents. So in other words, theta is distorted, and therefore we are set to roll to the next expiration date and close this trade for, let's call it 11 cents, and sell it again for 62, meaning that we're gonna collect $50 on premium there. So let's do that. Okay, the call side is to be rolled. I believe that this should be understood because it's not the first time we do it, but if anyone has any question or want me to repeat it again, just let me know this is the right time. So I'm looking at the 150 call, right click, and we're gonna be rolling it. Okay, so we are creating a rolling order where we're gonna be rolling the 150 call to become the 150 call from 19th of August to 26th of August, and this is supposed to provide 56 cents of credit. So let's do it. Let's see if I get filled at that price. If not, I'll push it, I'll force it, because I got filled at 61, great. Even better. Again, in the sessions, I often push the prices aggressively, so I get filled quickly to gain a bit of time during the session. So we got the call, okay, and therefore I want to create a compare spread scenario where we copy the primary spread, we edit the spread, and the call side, which is that 150 call here, I want to make sure that we all see how that is now moving from August 19 to August 26, and how we are adding to the $1.10 that we already have, how we are now adding 61 cents to that credit that we already had. So 61 cents means that this will become 171. Okay, so that's what we have in the account right now. You got filled at 61 cents. Great to hear, Joe. And when we do that, again, now the risk profile changes a bit. And you may say, oh, wait a minute, look at that. On the upper side now it goes down, it's all red. Again, yes, it's normal. It's the evolution of the trade, because, again, we're going to do this same action many more weeks until we reach October 21st. Okay, so we got still a few actions to do in August. Then we got the whole September, and we got multiple weeks in October. So as we keep selling premium, we keep lowering the cost of the trade, and this orange line, little by little, will be moving higher. Okay, so it's all good, even though it looks a bit ugly at this moment in time. It's part of the process of massaging the trade. Okay. Now, what about the put side? Well, with the put side, we are dealing with a 125 strike, and we're going to do the same exercise. Okay, same exercise. So we can see how theta is not even calculated, which means, obviously, the Greeks are distorted. Okay, and then we can see how theta here is, lacking a little bit of liquidity, to be honest, between 28 cents to 9 cents. So again, in a real account, be very patient to get filled at the best price as possible. The good news is that the 125 put we currently have, we should be able to close it at 2 cents or something like that. So we're gonna get a differential of premium by doing that. Okay, it's not gonna be amazing, but it's what it is, and it's time to do it. Okay, given our rules of identifying distorted Greeks. So here's the 125 put. I'm gonna right click the one that expires in August 19, which is tomorrow, create a rolling order, same story. And when we do that, it seems that we may bring in 16 cents. So again, it's much less. And by the way, before I do it, why is it so much less? Well, if we go back to top, right, and we look at the chart. So again, let me float this. I'll close this one. So when we look at the chart, and you look at 125, which is the purple line. So notice how the current price is way closer to the upper line than how close it is to the lower line. So because we are, closer to the upper area, obviously we get more from the calls than what we get from the puts, and that's why with the puts I'm only able to make 16, versus with the call, I was able to make, I think it was 61. Okay, so let's go ahead and try that 16 and see what happens. Okay, if not, I'll push it. Here, I would expect not to get filled as easily because we saw the spreads were wider, so volume, open interest is probably going to be at a different level compared to the call side with a 150 strike because of proximity, as I said. Therefore, you may need to work a little bit on replacing the order and maybe shave 1 cent at a time, wait a few minutes, see if you get filled. Again, I'm gonna try this 15 cents. If I don't get filled, I use a market order. Please never do that. Okay, never do that. I'll just do it with a market order if I don't get filled, so we can continue the session. We don't need to be waiting together here, just watching the screen. But at home, again, especially when we saw the 150, the 125 put, the one that expires in August 26. We saw that the spread ranged from, I think it was 9 cents to 28. So you can get hurt on slippage in a massive way if you were to use a market order. Okay, so don't do that. So you get something potentially better. Okay. So I'm gonna try, let's say 11. Let's see if I get 11. Okay. I got filled at 14. Okay. Thank you very much. So yeah. So I mean, it's a good reference for you to know 14, even though this is simulated, okay, but based on the Thinkorswim algo. So just keep that in mind in a real account. Potentially you may get a bit more, but you may need to be a bit more patient, okay? So we got 14 cents. So if I do the same exercise I did before, if I edit the spread and I take the put and I go from 125 August 19 to 125 August 26, and I got my 79 cents, right? And now what I did is I added 14 cents, right, to my 79. So 79 cents plus 14. That means that now I got 93 cents here on the put side. Okay, and by doing that, what's the net result? Well, the net result is a risk profile that looks like that, very similar to what we had before. Okay, but notice how, just like last week, the orange line went higher. Let me get this back inside top. If I dock it, and I go back to top. So if I look at the data window, so notice what happens now, that the risk of this trade used to be 975. The risk of this trade is now 900. Okay, so 973, 976, 901. So again, with the decimal places, it would be 976 or $901. Okay. So we are massaging the trade, reducing the risk while we're waiting for implied volatility to rise, where if that's the case, which should happen as we're approaching expiration date, we're going to get that effect when volatility rises. And now we have a much wider and much taller profit zone where this trade now would pay nicely. Okay, of course, we need all those elements to take place. And that's why we have a wide range. That's why, we are working with multiple expiration dates and we are working with patience. Okay, many of these trades end up with, let's say, an average profit. Some of these trades end up with a loss, but the loss is very much reduced when that happens compared to the beginning of the trade, because every week you keep shaving the loss. And some of those trades, from time to time, they will pay very nicely. So altogether, this is certainly a valid approach to collecting some monies from the market. especially while we are waiting for market conditions to really stabilize. In this case, the S&P to change climate and give us, an entry into a new climate at the right time, instead of, when statistically speaking is totally exhausted. Okay, so this is what we're trying to do. This is what we are doing actually. So I'm gonna copy this to the clipboard, back to positions, and we're gonna move it here, and that's where we are at. Okay, so, and by the way, the MU, I can get rid of that. We don't have this trade anymore. So now we are just working on Nucor. Okay, cool. Okay, so how is it going, guys? Everybody, you either type okay, all good, or you type your questions. Okay, that would be the time, and we're gonna start looking for market opportunities. Before Joe, I have not forgotten, we need to look at USO. Okay, so let's take a look at USO. But again, everybody, please type your questions if you have any, and if all is okay, please type all okay. Okay, that helps me a lot. Volume map. I believe this is what you wanted to see. You wanted to take a look at the volume map of USO. You wanted to look at September 16, which I have here, and I believe you are probably referring to the 75 strike, right? I would think that this is the case. Wonderful. Thank you for that, Mark. Anil, thank you so much. Jeff, thank you so much. Everyone, thank you so much, guys. This is great. Love it. So again, Joe, if I could confirm with you, is this what caught your attention, and is this what you would like to discuss today? I'd love to know. While I'm waiting for that answer, of course, we always have a little bit of, streaming delay, depending on where we are in the world. A lot of attention. Okay, got it. Good. So the first thing I want to do, because obviously this is, you could call it an anomaly, right? So the put side, it's only 5, where the call side is 2,962, right? So first thing is, wow, isn't it? So what is it that I would like to do here is, first of all, I would like to check at the open interest, okay? Because, there may be a relatively low open interest compared to the volume, and that would mean that there has been a lot of trading in and out, 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 like, for example, selling the call, waiting for a little bit of decay, buy it back, versus if there was plenty of open interest, which means that those options have been open and they're still there in the market. They have never been closed. Okay, so the open interest is certainly telling me something about that. Okay, now I am a bit shocked by those numbers, and I believe, to be honest, that we are dealing with a situation where maybe we have a little bit of how do you call this? My God, I forgot the term. Can you believe this? Wrong timing for forgetting a term. It's gonna come back. A bad tick. That's what I meant to say. We may have some distorted data on the database of either the exchange or the data providers, because it's very surprising for me to see 2,600 contracts of open interest, but only 5 contracts of volume. Okay, it's a very small number. Okay, now it may not be a bad tick, because again, the volume represents one day. Okay, so in order to get a bit more clarity of that very intense open interest and the volume, so I would like to compare the number 5 with the number 2,644 with what was happening one day ago, for example. So I'm just gonna drag the vertical line one day ago, and one day ago the 75 strike got 2,600. Okay, and on that day the volume was 167. Okay, so in the end, I don't believe that's a bad tick. It looks like okay to me. So that there is simply less activity on the put side and the call side for that strike, but certainly the numbers seem to be in line. Okay, so and now I'm lacking. Okay, give me a second. So I will add a few more strikes, because I'm going back one day before. Did I remove the study? Oh, that was so silly of me. Okay, sorry guys. I thought I had clicked on edit the study, but I guess I had removed it. Okay, let's put it back in. So edit study options volume map. And I just want to go back to here. And what I want to do is I want to do a few more strikes. So I'll do, let's say, six strikes above and below at the money instead of three, and go back 2 days ago. Again, we are looking at the 75 strike. So 75 strike got 205 contracts traded, 3,000 on the call side, so more calls than puts. Open interest also around 2,600 and 3,000 on the call side. So this is where it gets very interesting now, because it seems that the 75 strike that expire, the options that expire in September 16, the 75 strike got 3,000 calls of open interest, and the next day that number jumped to 5,000 of open interest, and today it's 14,000. Right? So the quantity of call contracts that are being traded, it's tremendous. Okay, and is indeed in line with the volumes that we can see. Again, we need to do the math and to be able to um, have a better guess when it comes to how many entries and exits have been done, because many of those calls could be just very short-term trades where traders are selling an out of the money call, and they just wait for that stock to drop a bit and they buy it back for a profit, instead of doing the classical application of, let's say, credit spreads, for example, where a trader may sell a credit spread and just wait for expiration, or wait for half of the premium to dissipate before buying it back, or things like that. So in this case, the numbers I see may represent a lot of much more active call trading, which is basically selling the call, waiting for the premium to decay a bit, buy it back, and so that's probably the type of action that has been happening there. Okay. Anyway, let's keep researching and trying to understand that, which of course it's always difficult because we don't know exactly why. But certainly, Joe, a good one, spotting market data which represent unusual type of behavior, if you wish. Those numbers are very, very significantly different, both from the volume side as well as from the open interest which is available at the moment. Okay, so good job. So I want to continue, but also I see some messages on the chat box, so let me take a look. It's been there a while though. Okay, that is okay. 5 or 6 languages. Thank you, Joanne. I'm wondering if institutions are expecting a pop in oil after the summer. Well, definitely the fact that you have observed that this 75 strike in September has been behaving the way it's been behaving, definitely tells you a lot about 75 as a price point, where 75 is indeed not only a strong but a very, very strong either support or resistance, depending if the price of the USO is either above or below that level of 75. So that's a relevant strike, and because it's very relevant, that means that it's either a very strong support or resistance. Okay, so if price manages to go 75, from a technical point of view, we should expect a powerful breakout out of 75 and a very strong continuation. Because there would probably be a lot of scaling in trades from those large market players that created 14,000 contracts of open interest. If price was to go to 75 and bounce down, you should expect a lot of bearish movement on USO, because of the same is true, right? Because a support, if traded through, becomes resistance, or vice versa. If a resistance is traded through, it becomes support. Or if a support or resistance is not traded through, so then it's very much respected by the market. So 75 is very relevant, okay, and definitely your observation tells you that. Okay, now is it relevant only after the summer, as you're suggesting, because of the September date? Well, one way to try to understand that a bit more would be to edit the options volume map, and instead of looking at weeklies, what we could do is to look at monthlies only, and maybe look at 6 months, for example, and take a look at what happened throughout the time to that 75 strike. And you can see how On September, you got 14,000, 2,000, which is that exaggerated, scenario. Next expiration date, 3,000, 3,000, pretty balanced. Next one, 128, let's say pretty balanced. Next one, you would say, okay, maybe it's not so balanced, but at the same time, the quantities are so low. I mean, 1,000 compared to 14,000 is nothing. So I would say it's not that relevant at all, right? So in other words, it does look like that 75 strike is a very relevant price point, but certainly it must have lots to do with seasonality patterns that are happening in oil. And I am not an expert in seasonality when it comes to certain commodities such as oil. So we need to bring an expert in that sense. But my guess would be that there must be an expected movement based on seasonality around that September date. So again, a pretty powerful trade setup. I mean, the bad news about these type of setups is that they only occur when they occur, and it's based on, in this case, it seems to be based on a seasonal pattern, and therefore it happens only, if lucky, a few times a year. But it's not going to happen in like a few times a week, so it's going to be more a few times a year. So that's the bad news. Those trades don't happen too often, but at the same time, these type of trading setups are indeed quite powerful from a statistical point of view. So because again, all those commodity traders around the world, they are looking at seasonality, and if price goes above 75, you'll have a lot of seasonal traders jumping into the trade, and therefore that breakout must be or maybe quite powerful. So certainly something to watch for. And again, the way to trade this, if you want to be aggressive, is if price goes above 75, you just become a buyer of a spread. And an option spread gives you the advantage of knowing that the most you can lose is what you pay for the spread. So you have limited risk, and now if oil moves, so you're gonna collect a much better profit. So you can just be like a simple breakout trader, if you wish, looking at 75, thanks to your identification of this abnormal behavior on the 75 strike in September. I would say a better way to deal with this would be to look for the evidence as well, that not only you have that relevant 75 strike, but also that you have UFOs forming as price is breaking out of 75. So, for example, if we go back here, so for example, not too long ago, we had a break. Okay, we had a break above 75, but then it came back down. So it was not a breakout; it was actually a fake out. Okay, so it didn't work too well. So it'd be interesting. I'd be interested to know. I'd like to know. So before the breakout take place, so what was the setup? So notice on the setup on the 55 minute time frame in this case, there was no UFO unless you went down all the way to 72. So that's not too appealing to me. Okay, that's not too appealing to me. I would have preferred to see some UFOs forming in those price points. Because now I know that if the breakout retraces a bit, those UFOs are going to push it back up. And these pushes to the upside is not like a UFO guarantees you for the market to go to the infinite, but those pushes create bounces, and bounces act as motivators of more of the people that were watching 75 to feel, okay, confirm, it's pushing, it's retesting and moving again, let's jump in. And all of those traders buying after you bought is what helped for a move to be continued. So again, I would certainly suggest in cases like that, at least based on my trading style and preferences, to be looking at UFOs that are forming not exactly at 75, but maybe just a little under, or if it's 75, even better, but somewhere around the 75 area, knowing that then if the price retraces back, now you have something to push it back up because the UFO was here. And in that new bounce, many new of those breakout traders that now got more evidence are going to jump in. Okay, so that's what I would be looking for, to take advantage of this market opportunity. Okay, one last thing I would like to do here, and this, of course, I'm diverting a little bit from the normal process that we do in the session, where now I would be trying to find opportunities to practice together. At the same time, since the opportunities today will be double calendars, which is similar to what we've done in the prior weeks. So I'm happy to spend some time looking at this because this is great. This is a unique opportunity that we don't see too often, and it's great to analyze this together and think about it. Okay, because there are opportunities in the market out there in many shapes and forms, and I don't know if I ever shared that with you guys, but I remember the year of the pandemic. There was this one day where there was an arbitrage opportunity that was like, the S&P ETF that was not halted was trading 10% lower than the S&P futures. That was halted because it hit its circuit breakers. And what happens is that you had a fantastic opportunity there where, it was a basically free arbitrage opportunity where you could make 10% on leverage, which is a humongous amount of money to be made by shorting futures the moment the market would start retrading, and getting long SPY, or getting long options on SPY, for example. The easy one. But I didn't trust my eyes. I didn't trust the trade. I didn't take it because I thought it was too good to be true, because it was crazy. I never seen an arbitrage opportunity of 10% in one of the largest markets in the world. That's crazy. But it happened. It was true. I even remember rebooting my machine to see if market data was correct, if that was true. Running different platforms, looking at the data is like, oh, it's the same. But still, I was not trusting it. It was too good to be true in my mind. So again, opportunities like that only happen, I guess, if you have a pandemic. Hopefully, not anymore. But at the same time, opportunities like what we're seeing with oil right now, those are relatively common. If you keep observing certain markets, sometimes you'll see patterns and behaviors that catch your attention. And again, the type of analysis we're doing now, it's useful to kind of like try to understand what's happening behind the scenes, and therefore how can one could take advantage of such opportunity. Okay, so thanks for that, Joe, and good timing as well, given the fact that I'm a bit relaxed today with finding new opportunities, because it would be double calendars again like we did last week. So it's okay if we miss that. Okay. Mark, isn't September when the refinery shut down to convert the winter gasoline formulas? I am not sure, Mark, to be honest. I am not sure. As I said, I am not an expert in commodities or seasonality. To me, when I trade the commodities, like markets like oil, to be honest, I exploit them from a short-term point of view with futures. That's my favorite approach, and therefore I really don't even pay attention to seasonality patterns or anything like that, because I'm in and out, and that's it. But you must be right, Mark, and certainly all those aspects have significant impacts in those commodity markets. Okay, there are huge amount of seasonal traders doing commodity trading, both using futures contracts or options contracts, or spreading. But not only spreading with options or spreading with futures, and also sometimes combining futures and options combined to create very complex market setups. So all of those things happen, and it's all because of those seasonality moves that are expected. Okay, so what you said there, Mark, is indeed very relevant. So one more thing I wanted to mention is, okay, so let's go ahead and take a look at the option chain. So we were looking at September 16, and we were looking at the 75 call. You can see here the 14,000 open interest, the 2,900 volume. We can see the limited open interest for the put, 2,600, only 5 contracts traded on the put side. So I'd be curious to see if there is any difference on implied volatilities. And here we can see that implied volatility, it's 41 for the calls. For the 75 call is 41. The CIV, the continuous implied volatility for the calls, is 43. Okay, so the implied volatility for that call is a little lower than the average. And on the put side, we are dealing with an implied volatility of 42. Okay, which is a little bit above the average of the implied volatility for the puts. So what this tells you, okay, and of course you cannot know for sure, but it's definitely a good indication. What this tells you is that puts are being bought, okay, and calls are being sold. That's what this tells you, because 41 being less than 43 means that these particular calls are being sold more than what they're being bought. That's why the prices went down. That's why the implied volatility went down. So calls are being sold, and the fact that the puts are trading at 42 IV versus the 40.5, that tells you, or again, we don't have a guarantee for sure of this, but it's a clue, it's a hint that is telling you that probably those puts are being purchased, and that's why the buying of the put is making the price of the puts to go up, and therefore there is more implied volatility built in. So which makes sense because 75 is above price, and therefore it seems that 75 strike is being seen as a resistance because selling calls and buying puts is bearish, right? So yeah, so again, if price goes to 75 and bounces down, time to short crude oil. If price goes to 75 and goes up, time to prepare for a breakout trade. Okay, this will be the interpretation of this market data. The other thing you can do here is to chart the underlying with options. And in this case, I would like to chart the 75 call. Did I click on the 75 call? I think so, right? Let me remove this. Yes, 75. Okay. So what we have here is a daily time frame. Let me make this maybe a 1 hour time frame. Maybe we get a bit more visibility of the market data. So what we can see here, this is the call prices. Okay, this is the call prices versus USO, which is the ETF. Okay, and of course, because it's the calls, it tends to track in a fair manner what that stock is doing, because it's a positively correlated options unit, right? If it was a put, it would be kind of like the mirror image, but being the call, it's very similar to the stock. Now, why am I doing this? Well, because here is where the volume took place. Now you can see, because I'm charting the intraday data, right? So now I can see when that crazy volume took place. And it seems that it took place, in a very small period of time. This is a 1 hour time frame. And it seems that this took place at 9:30 on the 17th of August. Okay, huge amount of volume there. That was 11,600 contracts traded. Okay, so what happened that day? Okay, that's something very interesting. So let me try to find a bit more detail. I'm dropping now to the 5-minute time frame. Okay, and notice that these things, we got 4,000 contracts traded at 10:20 and 6,600 contracts. Okay, I'm looking at it here. Sorry, I just moved my mouse. Okay, I'm pointing at this candle. I can see here the volume, green color. 6,691 contracts traded, and that would be at 10:25. So again, 10:20, 10:25, that's when all of this happened. So what happened? Okay, why is this happening? Okay, so what I need to do here, give me a moment, is I'm gonna bring in this case, I'm bringing in forexfactory.com, and I would like to look at what happened yesterday. Okay, and I would like to look at everything. Have there been any number related to oil? In this case, it seems it's crude oil inventories. And yes, it does look like probably it's a fundamental reason for this to have happened, because the prior number was 5.5, the expectation was 0.3, and the number that was reported was minus 7.1. Okay, the Fed announcement took place at 2 p.m. This was happening at 10:30. Okay, and notice how the movement was taking place like 10 minutes before. So in other words, someone knew the number ahead of time by 10 minutes. Isn't this funny? We are acting a little bit like detectives here. I'm having fun, actually. So someone knew, right? And someone was really heavily speculating on that 10 minutes before the number was officially published. So again, I'm not an expert in crude oil as an asset, again, from a seasonal or from a production company or from an industrial company point of view, and therefore I don't know if these type of divergences are normal, but it seems that 7.1 it does look like a pretty big report. Nothing like that was seen until April 2022, so that's a few months ago, and yeah, I'm just looking. So yeah, so the forecast is the dotted line, and in this case the blue line was so far away from the forecast, much more than many other cases where it seems that the blue bar it's closer to the golden dot, but on yesterday report, it was way further away. Okay, again, what's very interesting to see is that this was reported publicly at 10:30 a.m. This is New York time, and at 10:20 and 10:25, lots took place there with those calls. Okay, with that particular call, with the 75 strike. Okay, so someone kind of knew something. Okay, did something happen with, let's say, the 74 strike? Did we have the same? No. At 10:30 with 10:30 is right here. We got a little bit of a volume there coming in, but nothing major. Okay, so it was all about the 75 strike. So again, you could tell that market participants, very relevant market participants that know news 10 minutes ahead of everyone else, they are looking at 75 like something extremely relevant. Okay, so yeah, so that's the little bit of a detective work that you got me to do, Joe. Any comments, questions about all of this analysis? Okay, I'm just gonna go back to the charts. Gonna be looking for your feedbacks. Thank you, Joe. Thank you for that. That's very kind and indeed fascinating. Indeed, the markets are fascinating, isn't it? The things that happen. Yeah. In the end, again, it's great that we are looking at all of this. Okay, and I think it's a good day for us to do this type of analysis, as I said. But remember, in the end, we also need processes that are repetitive. So every week we can have activity in our accounts, right? Instead of looking for those trades where, I mean, that 75 strike looks like something really, really relevant, as we said. But again, if this happens once, every 4 months from April to August, so then you cannot be too active, and therefore the profits to be made would be limited. Okay. Yeah. So how can one take advantage of that, Mark? Again, my suggestion would be to watch the 75 strike, and if there is a breakout of 75, and there are UFOs around that price, as I said before, so then a breakout trade could make sense directionally to the upside. If price comes to 75 and comes back down without surpassing 75, in this case, price went to 75. Okay, in this case, price went to 75, surpassed it. Okay, so that was a failed breakout. There were no UFOs to support it. That's not what I'm looking for. What I'm looking for is, like, for example, now, if 75 is here, which, by the way, coincides with the UFO, and now price goes up, gets to 75, more or less around this, and comes back down, also planning on bearish trades on that asset would certainly make a lot of sense. Okay, would certainly make lots of sense. Because again, that resistance is seen as very, very strong by very relevant market participants. I mean, market participants that got the news legally or illegally, that I don't know, but 10 minutes ahead of the public. Okay, so that's basically that's the conclusion of everything we said. The conclusion is 75. It's an important number for crude oil, for USO, I should say. Cool. So we got 3 minutes to go, so really I don't have too much time to do much. So I'm just gonna say, if there is any question, or in general, if you guys want to share how is it going with your trading. Also, you also know that September is approaching. For the ones of you using TradeStation, I don't know if you have any question about TradeStation. By the way, there are many news happening out there with TradeStation. It seems that out of curiosity, just for you to know, guys, because I know some of you are using TradeStation, so they actually canceled the SPAC. TradeStation was going to do a SPAC, and they canceled that, which I understand. Again, all those news are, often is a little bit of gossip that you find online. So I'm not sure how accurate it is, but what I've seen is that TradeStation is canceling the SPAC, and they are getting in trouble with the venture capitalist partner that they have to do the SPAC, because they are suing them for cancellation of the agreement for the SPAC. So there is a lot of heat kicking in TradeStation in that sense, and this coinciding with the discontinuation of the App Store in September. So we'll see how things go there. But in any case, hopefully, if you guys have still questions about TradeStation, I am running 2 meetings a week with TradeStation clients to discuss it and look for solutions. So if anyone has a question, make sure you don't miss those meetings, because it's important stuff. So I don't see any comments or questions from your end, guys. So I guess that then we'll call it the day. We're gonna say we are done. I'd really like to see your buy on the chat box. So I know there is no questions left. And again, we'll see you. We'll see you on Sunday. Actually, we have a top session, isn't it, on Sunday? Let me reconfirm that. Time flies, so I want to make sure I'm not getting confused with the week. But I believe yes. We have a session on Sunday. Yes, we do. Sunday 21st, we have a top session where we'll continue our discovery. So I will see you then, everybody. Very cool. So again, today not much activity from an entry point of view of new trades, but again, some trade management and definitely a very nice conversation about USO. Some of those conversations that we cannot have too often because they don't happen too often. So Joe, thanks again for that and bringing that to my attention and sharing that thought with the group as well, because I guess that was a good learning opportunity for everybody. You guys take care, everyone. Yes, Mark, I'm with you. You guys take care. We will see you soon. Bye-bye. See you on Sunday. Take care, everyone.